I know you didn't have a chance to listen to Dalio, so let's just sort of get your latest thoughts on where things stand, given the new highs, given we're towards the end of earnings season. How would you characterize things, David?
Well, characterize the fact that the U.S. equity market is basically tracking towards our year-end target of 3,100. And baseline forecast, when you think about the environment, Fed's on hold. They've already cut interest rates now 3 times. That's basically consistent in our view with an economy that continues to grow modestly, and that's consistent with earnings growing. And so if you look into next year, in 2020, 3,400 is a target at the end of next year, which would be roughly 10% above where we are now. And that's basically reasonably optimistic environment that we're looking at right now. Big risk, of course, is what's the election.
There you go. And that's where I was going to go because, of course, next year does include a presidential election, about a year almost exactly from now.
Exactly a year from today. And don't forget, you got leap year for next year, so you get an extra day.
Thank you for that. You're always with the extra little bit of information, David. So, you, like a lot of other strategists, are now starting to put pen to paper in terms of what we should really expect, what we may see in terms of movements in various sectors as a result of the comments from the various Democratic candidates. You say there is rhetoric versus probability. What do you mean?
Well, the way I think about it is there's lots of noise going on, as there is in every presidential campaign season. So let's break that down into a framework of thinking about the overall dynamic for next year. There's an earnings sensitivity and there's a valuation. And so if you think about what earnings happens, one of the proposals, some of the discussion points have been to roll back a part of or all of the Trump tax cut that took place. And so that would represent now around 8 percentage points of earnings. So you had tax reforms, effective tax rates before the Tax Reform Act was around 26%. Today, they're around 19%, 18, 19%. So that gap, if you were to reverse that, that's worth some dollars. And so if you think about, we sit here today, you look at the end of 2020, the market's going to be pricing 2021 earnings. So our forecast is around $185 of earnings. If you were to reverse that tax cut, that's worth basically around $164 of earnings. So that's a bid ask. That's a way of thinking about it. Every 1 percentage point reduction or increase in the tax rate is probably worth around 1% of earnings growth. So that's part one of the framework. Think about earnings and you can come up with some certain assumptions. And then there's the valuation side. And what does the valuation suggest? What are the drivers of that? You've got economic uncertainty. You have consumer confidence, some of the other drivers of that. In our models, that suggests that basically if uncertainty was to rise for various reasons, uncertainty about policy, what have you, that's worth 1 to 2 PE points in the valuation of the market. So put some numbers on that. Market today trades at 18 times forward earnings. And 18 times forward earnings, you take that 1 to 2 points, that would be a potential 16 or 17 times. That's the way I would think about the probabilities for next year.
Is the ideal outcome for either one House of Congress to be opposite party than the White House?
Well, the history suggests that if you have a divided government, in some cases that's gridlock. You can argue whether that's good or bad from a social point of view, but from a market's point of view, at least has not a lot of things happen. So that would be modestly be consistent, I think, with our forecast. If you look at the markets, our pricing, they're assigning a very high likelihood in terms of the digital markets, very high likelihood, like 75%, that the Democrats retain control of the House. A little bit more than 50% likelihood in the forward market of the presidency moving to the Democrat side, and the most likely outcome is that the Senate stays Republican. To your point about a divided government, and that's consistent with our view of the economy basically continuing to move higher and earnings growing, and that's part of the baseline assumption of 3,400.
Where is the market now in absorbing where we are with trade and China?
Well, we look at our trade index, suggests more likely than not, you'll have some kind of a transaction. That seems to be the broad commentary that's coming out of Washington. And so the market's basically pricing that in, and some of the stocks that are exporting to Asia and to China have actually rebounded a little bit, reflecting that.
What are you seeing within the market itself in terms of particularly growth versus value, if I could call it that? I mean, we've seen a number of these growth companies that continue to lose money, but obviously I have higher profile. Uber, for example. Right. Even Peloton reporting a very strong quarter, down sharply. Are we seeing a divergence? Is there anything sort of that you can identify as a trend here?
Well, when last time I was on, we had a conversation about the IPO market and some of the drivers of that. And we identified, having studied 4,500 IPOs, every IPO done in the United States in the last 25 years. It basically leads to a conclusion that's statistically meaningful. The two variables you need to have for an outperformance of a new issue would be your revenue growth, right? Something north of 40% revenue growth, and your path to profitability, positive net income in year 2 or year 3. That is meaningful in terms of driving outperformance. So I think that would be a way of thinking about some of the new IPO market. And broadly speaking, to your question about growth versus value, in an economic environment where you see, as we anticipate, a roughly 2% modest growth, but still positive, that's consistent more with growth stocks outperforming value in this environment. When value does well is when growth is very, very strong, or when it's weak or contraction. So in this environment, I would prefer as a strategist to be owning more growth-oriented stocks. And where do you find that? Tends to be some of the technology area companies. You think of some of the industrial companies. ISM recently had a modest tick higher, and if that's a second derivative inflection point, that would be consistent with some of those stocks doing well as well. So
then where can oil end up in 6 months? Or how high can the 10-year yield go?
So Goldman Sachs, my colleagues in those areas, forecast basically rates modestly higher from these levels, basically looking at around 175 or so at the end of this year, maybe moving a little bit higher, a little bit over 2% for 2020. And if you think about oil, modestly higher, but that's not significant.